You're listening to the Scotiabank Market Points podcast. I'm your host, Greg White. Market Points is part of the Knowledge Capital series, a collection of audio, video, and written commentary from Scotiabank Global Banking and Markets leaders designed to provide you with timely insights and analysis. In what has been one of the strangest quarters in modern history, COVID-19 has brought record volatility and unprecedented uncertainty in the financial markets. Economies around the globe have slammed on the brakes. Travel and hospitality industries have virtually disappeared, and oil prices have plummeted. But what does this mean for the Canadian dollar? On this episode of Market Points, we hear from Shaun Osborne, Managing Director and Chief Currency Strategist at Scotiabank. Well, thanks for being on the podcast, Shaun. Thanks for taking the time today.
My pleasure.
So we hear the word unprecedented being thrown around a lot these days. What's your take on what we've been through, and what does it look like for you where we're headed?
Well, it just seems a never-ending process of situation of events and developments which we just have no comparison to in the modern era. I saw recently, I think, a comment that was attributed to Lenin, of all people, and he apparently said there are decades where nothing happens and weeks where decades happen, and it feels a lot like that. Over the course of March, we've seen massive volatility in markets generally, clearly a significant decline in equity markets, a price war developing in the oil markets, and all this volatility essentially being driven by the evolution of the COVID-19 outbreak and the enforced stop to economic activity in pretty much the entirety of the Western world now, following the hiatus that we've seen in activity in China, has driven markets to these unprecedented levels of volatility and losses, as you say, Greg.
The fact that they've, let's say, just talking about the equity markets, have made a little bit of a comeback lately, is that also sort of surprising given it's not like the news has started to turn around? Is that just because of the positive action that governments are taking?
I think to some extent everything seems to be happening at such a much more rapid pace these days than ever before. We saw through March, in the space of a little over 3 weeks, a 35% decline in the S&P 500, for example, and through the latter part of March, as the global central banks kind of rallied around to address this problem, slashed interest rates, pushed money into the system in again unprecedented levels. We've seen equity markets rally and recover almost 20%, in fact, to the recent high that we saw late last week. So we've gone in and out of a bear market by some interpretations of that status in less than a month, which is an incredibly short period of time.
And yet the expectation going forward is that we are going to be facing an unprecedented stop in economic activity.
Yes, that's right. I think the enforced kind of social distancing and shut out or shut in effectively of particularly in North America, and now the enforced absence of work will engender a very significant reduction in economic activity. This is not like your typical recession where things have, for various economic reasons, perhaps we've seen economic activity slow. Interest rates have risen to a point where the economy slows down. This is an enforced mandatory halt to all economic activity, effectively non-essential economic activity. And we think it's going to be pretty brutal. Our forecast at Scotiabank is that for the US economy, for example, we're likely to see in the second quarter, in annualized terms, a decline of around 20% in GDP. Again, never seen anything like that, certainly in the modern era, to compare that to. And for Canada, something even more severe than that, in the region of 24% in terms of the decline in economic activity. So we do think that growth is likely to rebound quite quickly once this virus situation is under control, and obviously we're hopeful that that happens relatively soon, but there's still an enormous amount of uncertainty about when that will actually be the case. But for the moment, we do expect a rebound in activity, a fairly significant rebound in activity in the second half of the year for both the US and Canada. But that's still going to leave the US economy down likely around 2% for the year overall. For Canada, a slower recovery from a deeper contraction. It's going to leave the Canadian economy down around 4% for the year overall. So recessionary conditions likely to prevail for certainly the bulk of this year.
And of course, the Canadian dollar has taken quite a slide through March. What's behind that?
But the Canadian dollar, like most of the other commodity currencies, affected very much by situations like this where economic growth slows. They're sensitive to the global economic environment. Slower growth usually means less demand for commodities. So the currencies like, for example, the Canadian dollar, the Australian dollar, New Zealand dollar, but also some of the Latin American currencies, as well as the Mexican peso, are termed the sort of higher beta currencies. They're more sensitive to slower and stronger growth. They react more. There is more sensitivity to economic conditions for those currencies. So with this enforced stop to pretty much all economic activity, we've seen since the start of the year, the commodity currencies generally have underperformed. The Australian dollar, for example, down 12% or so. The New Zealand dollar down something similar year to date. The Canadian dollar actually to this point has been a relative outperformer, but its losses have been compounded over the past few weeks by the outbreak of an oil price war, which is an unfortunate coincidence with the COVID-19 situation that we have. Oil producers, essentially Saudi Arabia and Russia, oversupplying a market that's very short on demand at the moment, and leading to a situation where oil prices have fallen significantly so far this year. WTI itself is down 60% just in March alone, and down 70% so far this year. The prices for some of the Canadian heavy crude blends, some of the benchmarks that we follow in Canada, they've traded at less than $5 a barrel in the past few days. So a combination of very weak demand as the global economy grinds to a halt, and oversupply as producers fight for market share, has driven this situation where storage capacity, both on land and sea, is reaching a limit. And we may be in a situation, just to make a very bizarre, an unlikely situation even more bizarre, a situation in the near future where unless demand picks up significantly, storage will be at a limit, and it may well come down to producers effectively paying refiners to take product off their hands, so negative oil prices in essence for the physical market. So that's obviously a highly unusual situation, which has compounded the pressure on the Canadian dollar. And we've fallen quite dramatically. We've fallen 11.5% in March alone, and pushed back to the 68-cent point, which interestingly enough was the low point in 2016, when oil prices were also under quite a bit of pressure. We had oil prices falling to around $26 a barrel in WTI terms. Back then, we've fallen to around $20 a barrel for WTI in the past few days. So a very similar sort of situation in that respect for the Canadian dollar. Weak oil prices been a key part of the Canadian dollar story here. But similar to 2016, we have appeared to stabilize a little bit around this 68-cent point now. And the Canadian dollar has actually managed to stabilize and come back to a little under 72 cents at the moment. And I think we may be in something of a range trade for now for the Canadian dollar at least. I don't think we'll see that much more pressure unless we see a significant deterioration in the outlook for the virus situation, for example. A lot of bad news is already priced into the Canadian dollar here at these kind of levels. So I rather think that downside for the Canadian dollar from here is relatively limited. But equally, while oil prices stay as low as they are, there's very little chance, I think, that the Canadian dollar rallies that significantly. So we're probably likely to pivot around a couple of cents either side of 70 cents for the next few weeks.
Through the uncertainty, essentially.
Yes, I think, as I said, we're hopeful that the virus situation has only a sort of limited, very pronounced, but limited in terms of the time frame impact on economic activity. Now, a lot depends on how quickly, especially in the US. I mean, I think the Canadian authorities are listening to the medical advice and the science behind epidemic outbreaks. But obviously, given the nature of a fairly porous border between Canada and the US, we can only really march to the beat of what happens in the US. And we're assuming, we're hoping that the impact of the virus is relatively short-lived. The economic consequences will be significant, but we're hopeful that we can move on to recovery in the second half of the year. If we see the virus situation persist, become more serious in the US, for example, that obviously delays recovery quite significantly.
How would you score the Canadian government policy action relative to our neighbors to the south? How's the Canadian government been handling this?
I think overall, in a pretty comprehensive and very pragmatic way, we've seen a kind of three-pronged approach from the federal government in terms of its fiscal support for the economy, significant, around 82 billion Canadian dollars thus far in terms of income support and tax deferrals aimed at offsetting the initial impact of this downturn or enforced unemployment for people. That was announced or heralded by the finance minister at the same time. The Bank of Canada a couple of weeks ago announced a significant reduction in interest rates, and sitting at the same table was the bank regulator, who announced some relaxation in capital requirements for banks, allowing banks effectively to lend more money at a time when obviously there's higher demand for credit in very difficult circumstances. So I think the initial response from the federal government, the Bank of Canada, and the bank regulators here in Canada was actually the full court press that we haven't seen actually in other countries. A response as united, if you like, as we've seen in Canada, hasn't been matched, I think, by other countries. And of course, we've seen since then the Bank of Canada follow up with more rate cuts and its first foray into asset purchases, not necessarily quantitative easing, as Governor Polos tried to make the distinction when this was announced, but large-scale asset purchases aimed at essentially ensuring markets continue to function normally.
Are the central banks in the leading economies starting to coordinate their efforts here? Or are they just taking the lead from the Fed?
I think there has been some attempt at coordination. We're not quite, I think, back to this sort of heyday of G7 central bank coordination of the 80s and perhaps early 90s. There has been a bit of a struggle, it seems, to come to a united front on a statement of intent. There's been a couple of attempts, apparently, to get a statement out that would present a united front. It's been a bit difficult, I think, for various reasons. Beyond this particular issue, to get that statement out, but in essence, the Federal Reserve is leading other G7 central banks, other large major economy central banks, I think, in its efforts, and becoming essentially the central bank by ensuring that there is adequate, not just domestic support for economic activity, but a key issue that we saw emerge initially in this crisis as markets started to freeze up was just a shortage of dollar liquidity outside of the US. The dollar is the global medium of transaction. It's the basis of a lot of borrowing, a lot of credit products around the world. A lot of inventory and trade is conducted in US dollars. And in times like this, when markets start to freeze up, banks become reluctant to lend. Owners of US dollars tend to hoard US dollars and not allow them to circulate more freely around the economy, if you like, or the financial system. So there was quite a severe shortage of US dollar funding, US dollar liquidity offshore. And the Fed has done a magnificent job, I think, of um, ensuring access to dollar liquidity um, globally in a way that is again unprecedented, even on a grander scale that we saw in the wake of the financial crisis in 2008, just to make sure that the um, global financial system continues to function and again avoid those disorderly market conditions that central bankers really abhor.
Does that mean we should expect a stable US dollar going forward over the next few months?
It's a good question. I think the dollar tends to benefit in times of uncertainty to some extent. It's maybe not the sort of classic foreign exchange safe haven that we tend to think of, like the yen or the Swiss franc. But if there is a shortage of, there is a liquidity premium in effect on the dollar. And as we saw in 2008, in that initial phase of the housing crisis when liquidity was again very tight, the dollar rallied and rallied quite significantly. So we did see some signs of that dollar strength emerging with the Canadian dollar, as I say, falling to that 68-cent point in March. Other currencies were under quite significant pressure as well. Sterling fell below 120 into the teens. The euro was under a fair bit of pressure as well. But as the Fed has addressed this liquidity issue and ensured an adequate supply, an overabundance in by some measures of dollar liquidity, the dollar has actually slipped back a little bit now, and I think we may well um, be in the early stages of some sort of retrenchment in the US dollar against most currencies. It may be a little bit slow in coming against the Canadian dollar. We have that oil price issue still as a drag on the Canadian dollar's performance. But the Fed really has um, pledged unlimited support for the economy, so unlimited quantitative easing in effect, and it keeps on wheeling out these new programs to ensure that there is adequate dollar liquidity in the global financial system. And I think that will tend to weigh on the US dollar over time. Again, as we saw in the wake of the financial crisis in the US in 2008, 2009, when the Federal Reserve first wheeled out the initial iteration of quantitative easing, the dollar did come under some pressure as the global supply of dollars increased dramatically. Now, all central banks are in the same situation at the moment, and there's very little room for, I would say, fundamental discrimination amongst currencies, the major currencies, at least at this point. Interest rates are effectively at zero or below that for most major central banks. We know that most major economies will see very significant declines in GDP growth, higher unemployment over the course of the next few months. We know that most governments are going to be borrowing heavily to try and offset the impact of COVID-19 on domestic economies. And the only differentiation, perhaps, is just how far down that road these central banks will go. And I think the Federal Reserve has immense firepower here to deploy to try and ensure that the US economy stabilizes as quickly as possible. And I think that will count against the US dollar to some extent because we will see, I think, the Federal Reserve's balance sheet grow dramatically in the course of the next few months. We've seen a 1 trillion increase in the Federal Reserve's balance sheet just in the month of March alone. And that process is likely to continue going forward. And I think eventually that weighs on the US dollar in essence. And we do expect in the second half of the year, the US dollar to pull back a little bit more, obviously.
What's the big thing you're looking for in April?
Boiling it down to one big thing is going to be kind of difficult. I think a couple of things I think is to keep an eye on. The equity markets fell dramatically in March, and we have seen signs that maybe investors are starting to discount the worst here. There was what was termed a dash for trash in the equity markets, with investors rushing into the more beaten down stocks in this week or so, bargain hunting essentially to try and buy some of the more depressed equities. It's still probably a little too early in the process to determine whether a low is really in for equity markets at this point. We've seen a significant rally off the lows. The S&P 500 is 20% higher than the lows we had just a week or so ago. So a significant rebound already. It's going to be Hard to sustain that pace of gain, however, given the backdrop that we have of slow growth, higher unemployment, and the uncertainty around how the virus will develop from here. So I rather think that a risk appetite is perhaps going to be the big driver of currency markets in the short to medium term. So over the course of the next month or so, if we can see risk appetite strengthen, that's to say equity markets rally a little bit more, that should be good for the Canadian dollar. If, on the other hand, we move to retest the lows that we had in the S&P 500 or the other major US indices in late March, that's probably going to weigh on the Canadian dollar to some extent. So I think the outlook for equities, volatility essentially, is probably going to be, in the short run here at least, the determinant of whether the CAD gains 2 or 3 cents from here, or if it drops back 2 or 3 cents from current levels.
That was Shaun Osborne, Managing Director and Chief Currency Strategist at Scotiabank. Be sure to tune in for further episodes of Market Points, and you can find more thought-leading content from Scotiabank on our website at gbm.scotiabank.com. And you can also follow us on Twitter at ScotiabankGBM, as well as our LinkedIn showcase page under Scotiabank Global Banking and Markets. Please refer to our legal disclosures on our website. And of course, thanks for listening.